I urge my colleagues to support my legislation, the Bank Resilience and Regulatory Improvement Act, which will provide financial institutions with the relief needed to serve their communities and customers without the punitive regulatory and supervisory burdens that impede them from doing so currently. This is really about unleashing the American dream. This legislation does a number of different things. One, it tailors regulations for small and mid-sized banks so that they can meet the demands of their markets without being held back by onerous requirements that are not appropriately tailored. Second, it creates a shot clock for merger applications at the Fed, OCC, and FDIC to provide timely decisions. Third, provides transparency in Federal Reserve stress testing to better understand capital requirements that are developed from the results. Fourth, creates an improved process for supervisory appeals so institutions are able to obtain a fair shake with such conversations with their regulators. And fifth, requires transparency and action to improve and update discount window operations at the Federal Reserve to fit the needs of potentially fast-paced liquidity needs of solvent financial institutions. Small institutions face higher hurdles in the regulatory environment. This is why my colleagues from both sides of the aisle and I work tirelessly to include tailoring in S2155, and why we are highly concerned about the federal regulators' recent flawed proposals that repeal this tailoring and move to a damaging one-size-fits-all approach. Certain asset thresholds put forward in the Dodd-Frank Act are too low, and burdensome regulations continue to plague the mid-sized banks. To provide these institutions with the relief they need so that they can provide financial services to their markets and reduce high regulatory compliance costs, we must raise asset thresholds on certain regulations. At the very least, we must recognize that the thresholds from more than a decade ago do not properly account for price and asset value inflation that has occurred in the interim. And this is getting exactly at the point that the gentleman from Massachusetts earlier made, that these are the institutions that faced deposit outflows in 2023 after the instability in March. Another way to ensure that small, mid-sized, and regional banks can meet economies of scale and meet market demands is through mergers and acquisitions. Mergers of financial institutions can promote competition and generate cost savings that can then be passed on to consumers, and they help preserve a robust banking system. Mergers also allow, importantly, distressed banks to sell themselves instead of failing, thereby insulating the Deposit Insurance Fund from losses. This is why I call this bill the Bank Failure Prevention Act. Unfortunately, the current slate of Democrat-appointed regulatory officials would like to eradicate any chance for healthy mergers to be approved, putting the Deposit Insurance Fund at greater risk. Implementing a shot clock will improve timeliness and set clear expectations for the merger application process. Another provision of this legislation calls for transparency and clarity on stress testing, which currently involves a black box in which numbers magically appear without adequate explanation as to how they are generated. To remove opaqueness between the Federal Reserve and the institutions subject to stress testing process, a rulemaking requirement must be implemented. This will allow for proper public engagement and insight into the U.S. capital framework. This insight allows Congress to properly oversee the Federal Reserve to monitor the stress testing process and the capital framework. To continue with improving the regulatory regime, the legislation includes a provision on amending the supervisory appeals process. I often hear that institutions do not appeal their supervisory findings because they do not want to question their regulators and feel that there is not a meaningful process. Due process is the cornerstone of American freedom, and this legislation will allow and promote institutions to meaningfully exercise this right. Another area of our banking system that hinders institutions' resilience is the discount window. As Fed Chair Powell admitted following the March 2023 banking instability, the operation of the discount window lending can be clunky. To resolve this legislation requires transparency and a plan from the Fed to identify and to remediate problems in discount window operations and to adapt those operations to better fit the sometimes fast-paced liquidity needs of distressed financial institutions. Better discount window operations could have prevented some of the bank failures that we saw in March 2023. Creating a regulatory environment that promotes transparency, accountability, and dynamism is necessary for enhancing financial stability and allowing safe and sound financial institutions to prosper. The Bank Resilience and Regulatory Improvement Act requires federal banking regulators to foster this environment so our community, mid-sized, and regional banks can comply with regulations in a meaningful way that allows them to be competitive and thrive. This legislation will reform our bank regulatory environment for the better and will especially benefit our smallest institutions. All my colleagues will agree that diversity of our banking system is what makes it the envy of the world, and this legislation protects and enhances this diversity. I urge all my colleagues to support the bill, and my time has expired.